Jim Carroll, the VIXologist. VIX actually had a heartbeat yesterday, Jim.
Can you hear me, Dale?
Yeah, I got you. So,
Okay.
a little
I'm
bit of
gonna
a pulse. Is
I'm
the
gonna
VIX
throw.
is the VIX going to become Lazarus and rise from the dead?
uh, of course it will. We just don't know when.
Yeah.
Let me throw some slides up.
Okay, Jim. And how are things going in the new enterprise?
Excellent. Really well.
Good. Glad to hear that. All right. So, selling volatility was another huge trade this fall.
Yes, it has
You know,
been.
something I noticed, Jim, and I'll never ignore it again, that when we were near the lows in late October, the VIX made its high when the S&P was 4170, and then we had a little bounce, and then they took the VIX, the S&P's down to 4110, and
Hmm.
the VIX made a lower high. It could not get through that, even though price was lower. The VIX couldn't take out that high. That was a pretty good market tell. If you were long VIX, you're going, what? Why?
Yeah.
Markets at new lows. It's not performing. Maybe there's a message. There was. I
Yeah.
ignored it, but I won't ignore that again. Do you find that at turning points that VIX can be a pretty good market message both ways when it's not confirming the move?
You know, um, I think most people who have been in the markets for a while and use any form of technical analysis have divergences that they watch. And it could be a breadth divergence. It could be a divergence between the large caps and small caps. It could be
Yeah,
any number of things. But I think that, and the short answer is that nothing works all the time. But
right.
as you pointed out, there are times when a divergence shows up. VIX makes a lower high against a lower low in the
Yeah,
S&P, and you know that may not mean reverse course and bet everything, but if you're in a position that's been working on the way down, that may suggest that it could be time to close that one and look to go the other direction.
yeah. Anyway, I know that since you follow it so closely, that you see market tells. Actually, they're messages that you get. I'm not saying that every message is
Yeah.
accurate, but
No, but I think
or it's going to
I
work.
yeah, that exactly. And I think, however, that there are a lot of people who have money invested in the market and perhaps are even relatively active as investors who don't pay attention to some of these things. And, I think if you're just kind of have it on your checklist, it can be helpful. Anyway,
Okay, look,
let me
what?
run. Let me take a quick run. Can you see my
Okay,
slides?
got it.
Okay. Um, so I was with you in August. What's new since then? We've got a Middle East conflict. I kept Bank of Japan on the list. I heard Blake talking about it. It's still out there, and a lot of people. The funny thing about Bank of Japan at this point is that so many people are watching it that it probably won't matter, but we'll see. Um, Treasury issuance, um, I think, is hasn't necessarily gotten enough credit around the turn at the end of October, because one of the critical things that happened was that Treasury kind of shifted what they were putting into the market. I think people were concerned about how much duration they were going to try to refinance,
Right,
and they came in with bills instead of notes,
right.
and that gave everybody a little sigh of relief. We've also had the, and I put pivot in quotes because we'll see, but obviously the dovish Fed meeting more recently, that's all of that stuff has resulted in what was a post-COVID VIX low. And the other thing that continues to get big attention, and I've got, an interesting slide in here that's been making the rounds, is, what the hell's going on in the derivative market? Are derivatives the tail wagging the dog? I think that's, an increasingly important topic. So
Okay,
anyway, here's where we are. As you can see over on the far right, we have cracked below the lows in VIX since before the pandemic. And obviously the tail at the very right, is the collapse that we saw most recently, which I'll come back to. Where are we in the big picture? This is one that I've shown before to your audience. And it's one that I just, I continue to keep an eye on. Where is the 1-year rolling average of VIX? Because when that rolling average gets to be above 20, there tends to be much bigger up and down moves in the overall market. We've now drifted back below 20. Does that mean that 2024 is going to be all calm, smooth sailing, lower left to upper right? I don't know. There's a lot of stuff going on in 2024. But, the market has calmed down a lot in recent months. Another way to look at it, this is the volatility term structure using just the SIBO indices, the 9-day, 30-day VIX, 3-month, 6-month, 1 year.
They're converging.
Yeah, well, converging and have plummeted dramatically, since the scare, the regional bank scare back in March, which was the, high watermark for this year. And, this was done before yesterday. But as you can see, that green term structure is has some contango in it. We'll look at the futures market along with this, but people have calmed down a lot over the course of the year. This is what the term structure looked like before yesterday. 2.5 vol points with 17 days to the January expiration. And it was a pretty fat premium that could attract even more short sellers into the volatility market. We shall see. Yesterday was a classic case of what I refer to as a punch in the face. We have a term structure that, had very steep contango going into Wednesday's VIX expiration. Even yesterday at the close, we still had very steep contango. We just saw, a case of the nerves where the entire term structure lifted, and from front to back. So it was a risk off feeling. We're recovering some of that today. We'll see. And there are a lot of fingers pointing as to what happened yesterday. I don't think I really care. But
can you explain to our viewers what Contango is?
Yes, absolutely. Contango in the VIX futures market basically is saying, if you think of VIX futures as insurance, because if you're long VIX futures and things go bad, the VIX futures tend to rise in price, right? So it's a hedge, and that cost of insurance reasonably should go up over time. And so in normal market circumstances, 30 days worth of insurance, if you look at this and you say it's priced in that 15, 16 neighborhood, and if you want, a year's worth of insurance, you're going to have to pay a premium. And so in normal circumstances, that term premium results in this lower left to upper right term structure. Insurance costs more for, the longer the coverage is. That to me is the most simple analogy. Okay. And when people get into a real panic, the other side of the term structure, when it's upper left to lower right, and I don't have an example in the slide deck, is called backwardation. And that's when, there's a huge spike in the cost of near-term insurance.
Right.
But people are less concerned about, a year from now. They assume, if we go back to the pandemic, the short-term cost of insurance blew out the roof. the cost of longer term insurance, did not go up as much. So you had the backwardated term structure.
So right now, Jim, is both short-term insurance and long-term insurance near historical low levels, basically cheap insurance, short and long-term.
Well, it's relatively cheap. It's not as cheap as it was at the lows in 2017, but it's in the normal configuration. People expect that there's less to be concerned about near term than there might be long term.
I see. Okay, thank you.
Now, this is just a sort of a historical study looking at VIX and annual ranges and average values. And what you can see, again, going all the way to the far right of the slide, is that this year so far, VIX has traded in a pretty narrow range with an average, right around 20. So, we've been fairly calm. One of the reasons we've been fairly calm is that realized volatility for the S&P, and here I'm measuring that using 21 trading days, or the equivalent to the VIX, has also been in a fairly narrow range and low on average. So if there is no realized volatility, then people are likely to be less nervous, and therefore the price of implied volatility will stay low as well. And that's what we've seen. Here's a graphic example, and you can see the normal configuration when you're looking at VIX futures. And here I'm using, the 30-day combination, 30-day weighted average of the front 2-month contracts. That's VX30. VIX is the spot VIX, and RV21 is that realized standard deviation for the S&P. The normal configuration is that VIX futures trade at a premium to VIX, and VIX trades at a premium to volatility, because that's historical volatility and the VIX looks forward. So you would expect the VIX to take into account the possibility that volatility rises. So red should be above black, should be above green. And what we saw, here in this most recent episode was that, from the end of September through the end of October, we saw an increase in both implied and realized volatility. I think, maybe people were nervous seasonally. October tends to be a month where things can blow up. But we've seen a collapse in realized volatility.
Right.
And that has helped bring implied volatility down as well. And if you
would you expect a mean reversion here, Jim?
Well, I don't know what to expect. Is realized vol is at a level that is obviously very low, and so you can see that implied and spot have not chased it down to those low levels,
right.
And I would expect that it won't get chased down to those low levels. That people will expect that there'll be some uptick in realized vol. So I if I had to bet, I would bet that the green line converges back toward the red and the black lines.
Okay. There are a lot of Super Bulls talking 6,000 SPX next year, even higher. Where do you think the VIX would be if we were at 6,000 S&Ps? 10?
Some people are talking, have been talking about 2024, being 2017 all over again. Well, the big difference is that 2017 was not an election year. It followed an election year. So we knew that, Trump was in the White House. We don't know who's going to be in the White House coming out of the 2024 election. So, if the
we don't
S&P,
even know who the candidates are going to be.
Exactly. So if the markets, just continue to rumble higher, I would actually expect that there would be, some reasonable floor on implied volatility and the VIX futures, because I just think people are going to be looking for ways to insure their portfolios against potential, large volatility events. And we don't know when that's going to happen because, again, who are the candidates? That's one event that has to come to play. Who wins the election? That's another major event. And there's all kinds of other things going on. So I would not be surprised.
Let me ask you this, Jim. If we have no election and martial law, would the VIX rally to 25? Just kidding you, buddy. Anyway.
25?
I hope, yeah.
Let's put a zero on the end. Let's put a zero on the end of that.
Yeah.
Yeah, I was going to say 50. Holy cow. Yeah. And good morning.
Yeah. So anyway, it was a joke, hopefully. And, with what's happening here, do you have a feel for other election cycles, or is this probably the most uncertain one? The most radical.
This one takes the cake in my lifetime, Dale.
Okay.
You've got fans and partners all over the world. Maybe they've seen, some crazy stuff in their home countries. Yeah. But I think in the US, this one's sizing up to be as wacky as they get.
Yeah.
Quick slide, just another measure of volatility, which has been lacking this year, is the number of plus or minus 2% daily moves in the S&P. This year they just have, we ain't seen it.
Yeah.
VVIX, the volatility of VIX, again, it's a broken record, but the average level, around 90 this year, the range fairly narrow relative to historical levels. This is, again, my measure of the VIX futures, again, below average of the past several years, fairly narrow range, not a lot going on. One thing that some people like to look at is, is the VIX behaving the way it should be relative to a change in the S&P? And, the answer is that, 2021 was actually a big outlier in terms of VIX not behaving the way people thought it should. And this year we're sort of back in a relatively normal range. We would expect VIX to go up when the S&P goes down. We expect VIX to go down when the S&P goes up. Doesn't happen all the time. But one of the things that I keep an eye on, and all my buddies in the volatility world do, is one of the tells in 2018 before Volmageddon was that we had S&P continuing to go up, but VIX was following it higher. So people were getting increasingly nervous with the rally. We've seen a little bit of that recently with volatility, not going down while the S&P has been going up. So, it is one of the things that we keep an eye on.
Okay.
Very recently, we saw what, I call, and it's not my terminology, but, the VIX trading in a very narrow range, what we call a squeeze, and it's measured using combination of Keltner channels and Bollinger Bands. When the Bollinger Bands get inside the Keltner channels, you've gotten really quiet, and this is, what it looked like. Now, then we had yesterday, and is that going to be a breakout? Well, it's fading back inside today. So we'll see what today brings, because yesterday morning there was nothing going on. And then all of a sudden in the afternoon, it kind of blew out. So we'll see what's going on. But when volatility trades in this narrow a range, after having dropped the way it has since, October, you want to keep your eyes open for a move higher. Sometimes it's a fake out. Sometimes it's a breakout. We'll have to wait and see.
Okay.
Talking about derivatives, this is a chart that's been making the rounds that looks at the number of ETFs and the AUM in ETFs that use some kind of derivative strategy. It might be covered calls, it might be selling puts, it might be, you know, whatever it's doing, it's doing. And part of this is because, you know, the SEC finally allowed ETF providers to put ETFs, you know, in there, or put derivatives in their ETFs and use active strategies. So part of this is just, you know, pent up demand finally being realized. But I think, you know, it's another thing that's important to keep track of because, you know,
Is
in
that
2000,
an accident waiting to happen?
well, you know, I am concerned. I don't know if it's the kind of powder keg we saw with short volatility at the end of 2017, but you know, derivatives are clearly a more significant element of today's marketplace, whether it's, you know, covered calls or zero DTE. You know, the flows in the derivatives markets are having, you know, an ever greater impact on dealer books, hedging flows, gamma. You know, we keep hearing these gamma, Vanna, Vega, you know, Delta. It's all about the derivatives. And, you know, I think that it's just different. You know, it doesn't necessarily mean that, you know, there's going to be some nuclear explosion, but you know, there's a lot more stuff that is subject to being unwound than there ever has been before.
Can you equate more derivatives with greater leverage or no?
You know, at a fundamental level, you know, a derivative, you know, has embedded leverage. And so, you know, there clearly is, you know, some leverage associated. And obviously, as you know, you know, a covered call is a lot different than, you know, a naked put sale. And so, you know, this is, you know, collecting all that stuff together and not really parsing through it to say what's more speculative than not. And it really would be the more speculative positions that, you know, would be potentially market moving. And it's really tough to measure that carefully.
I've seen, you know, derivatives that never existed, a derivative that you could bet on the long or short side of Tesla, you know, things like that weren't around even a few years ago.
Yeah. No question, they've become more popular. You know, they are potentially very lucrative as investments, and potentially, you know, go to zero. And there certainly are more and more people using them. How many of those people really know what they're doing? Good question. You know, it's just something I keep my eye on. And then there's one more thing that caught my eye. The chief economist from Apollo, who's a thoughtful guy. He's not a crazy person. But, you know, I think this is the other, you know, one of the big questions for 2024 is what's going on with the Fed, what's going on with interest rates, and what's going on with inflation. And to the extent that the Fed does indeed start to bring interest rates back down, is that a good thing? Or does that mean that we are on a roller coaster like this one that goes back to the 70s and early 80s? You know, it's in theory.
So he's looking for them to trough out in 24 and start heading back up to new highs.
He's suggesting that, you know, that you better keep your eye on it, because that could happen if we lower interest rates into a strong economy. And by all measures, the economy is reasonably strong. You know, housing prices are going up, housing starts are going up, unemployment's okay, yada, yada, yada.
Yeah.
You know,
Why do you
if
think
interest,
that? Why do you think they're pivoting then?
I, I, I think
I mean,
that,
was he under pressure to do this? I mean, you know, it is a political year, and you could say the Fed isn't
yeah,
political,
no,
but
no, look,
you think there was political pressure? I know that, you know, before October, all the home builders were screaming,
mhm,
and the realtors. The housing industry is a pretty big lobby
mhm.
in Washington, and they were making loud noises
You know, you
about
certainly
rates.
can't dismiss, the influence of different people, both in the political world and in the economic world, in the business world. You know, who wants higher interest rates? You know, savers,
That's it.
and that's about it.
Yeah.
So, you know, I think the Fed certainly um, wants to be seen as kind of thoughtful and sensitive. But you know, I think we need to keep in the back of our minds that um, that this chart could play out, and if it
Yeah.
does, you know, it probably results in higher for longer, and this would create some volatility.
All I could say is, Chairman Powell, you're no Paul Volcker. I traded under the Paul Volcker regime. You have just done an Arthur Burns, and if you're still Fed chairman, you're going to have to go back on into this tightening regime before 24 is up. So anyway, that's what I think. It happened 3 times in the 70s.
Yeah, it did.
So this is just round one. And
It
you
may
know
well
what?
be.
And it's a championship interview. It was with you, Jim. I really appreciate you stepping up and being part of the rotation of very talented, insightful guests that we have here on Face and that you've been contributing for years now. And I want to wish you and your family, friends, and all your clients, you know, happy holidays, buddy, and have a great 2024.
My son's supposed to get engaged in the next week, so that's
Wow.
big news. Big news on our front.
Okay. All right. Well, congratulations. Are you already a grandfather, or this will be the guy
No.
that'll do it for you? Okay. All right. Well, anyway, Merry
Thanks,
Christmas, Jim.
Dale. Same to
And
you and your crew.
all right, really appreciate what you do when you come in here. So
Thank
that's
you.
Jim Carroll, everyone. Where's the best place for people to follow you now, Jim?
Well, I'm still at Vixologist on X or Twitter. I still call it
I
Twitter.
know. Yeah, I know.
And you know, that's an easy way to keep track of what I'm thinking. And my DMs are open for, you know, people who may want to be in contact more directly.
Okay. At Vixologist, Jim Carroll, everybody. Thank you, my trading warrior brother.
Thank you,
Appreciate it.
Dale.
All right, man. So everyone, have a great day today. We'll wrap it up, thank God, tomorrow. TGIF tomorrow. Don't just count your pips or your volatility positions, count your blessings. See everyone tomorrow. Join the team in 14 minutes for the morning edge. I think they're still doing that. And you're welcome, everybody. People enjoyed it, Jim. Thanks again, buddy.
Thanks.
Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.